What's going on, everybody? It's Jamel Gibbs, your family-oriented entrepreneur. Welcome to this live today. We're talking with Anthony Russian, and we're going to get into first lien HELOCs. This is a topic that we've covered a lot on this channel in the past, but today we're going to add a little spin to it. So what we're going to do is get into first lien HELOCs, not only for your primary residence, but how you can use it on rental properties. This is a brand new program Anthony and his company are rolling out this week. And we want to discuss how it can benefit you as real estate investors. What's going on, my brother?
Nothing much, man. I'm just excited to be here and chat with you and share what we've got with everyone here, and hopefully provide some information, education for anyone who's watching, and maybe provide some value, help you out. So that's really kind of what we're doing. So yeah.
Absolutely. So look, guys, if you are interested in seeing how you can take out first lien HELOCs on your rental properties, we're going to cover all of that stuff in this video right now. First off, tell us who you are, where you're from. I want to give you guys a shout out. We're going to have a lot of fun over the next hour or so. Towards the end of this segment, we're going to be taking some questions. So don't be shy. Ask all the questions you need in that chat box right there on the side so that we can get your questions answered. And there's no such thing as a stupid question. Okay. If you have a question, chances are other people are going to have questions as well. They're going to have the same exact question. So don't be scared to ask your questions. That's what we're here for. We're here to help you make educated decisions with when it comes to buying rental properties or even funding them through this first lien HELOC scenario that we're going to talk about today. First and foremost, Anthony, my man Jerome from Jerome Allen from Philadelphia wants to give you a shout out. He said, "What's up?"
Hey, Jerome, how are you? Thanks, man. I appreciate that. Thank you.
Yeah, man. We got Sandra Clemens from Philly as well. So we got two people from Philly. I used to live about an hour outside of Philly, in the Berks County area for about 8 years, man, before I moved down to North Carolina. But yeah, if you guys want to shout out again, tell us who you are, where you're from. In the meantime, Anthony, tell us a little bit about yourself, brother.
Yeah. So my name's Anthony Rushing. I'm the sales manager of our mortgage branch at a bank called First Savings Bank, and we solely do first lien HELOCs. It's a mortgage product that we specialize in, and we offer it in a specific way to help people accomplish different goals. The main thing I think that we do that makes us unique is we teach people how to use this particular product. All in all, a first lien HELOC, it's a mortgage product. I can tell you how it works all day long, and it is what it is. But to understand how to leverage how it works for your benefit, that's what we help people understand and learn. We teach them the rules. That's kind of the way I like to think about it. The rules of this particular loan, they're different than an amortized mortgage. And because they're different, you can treat it differently. So we just teach people how to leverage these rules to optimize how it works, right? To maximize the benefit of this loan. And just like anything, right? In the right hands, it can be really awesome, right?
Mm-hmm.
When people use it the right way, and when what this offers aligns with what they're trying to do, it can be a really amazing outcome that can be surprising just because people haven't heard of it too much here in the States. So the concept we learned about it, this is the main loan that people do in Australia. It's really popular in South Africa, throughout parts of Europe as well. So it's pretty common throughout different parts of the world, just not here. So learned about it, kind of took it here, and really just want to share, advocate for what it is, how it works, how people can benefit from it. And for those, for people that learn about it, see if it can help you as well. So that's kind of what I do now.
Good stuff, man. Now, I know that you guys, and I'll get into this in a little more detail in a bit, but I know that you guys have recently merged or sold your bank.
Yep. First Savings Bank just got bought by First Merchants. One of the main asset classes that the bank has, that First Savings Bank has, and that First Merchants is interested in, is the first lien HELOC product. So great thing is they're about, I want to say they were about an $18 billion bank, and we were about a $2 billion bank. So I'm excited about having access to larger, a larger bucket, we'll call it, but also a group of people who I think are understand how to scale certain things and hopefully be creative with different products. One that we've got right now is the investment property first thing that we're rolling out, kind of like what you mentioned earlier. So yeah, did that. So the good thing is a lot of the operations and the a lot of the procedures and processes we have in place with that move is going to be we're going to keep a lot of those intact. So I imagine it should be pretty smooth going from one to the other. So.
For sure, man. Shout out to Keisha from the DMV and JR from Jacksonville, Florida as well. I wanted to dive into, well, let me take a step back. Generally, we talk about first lien HELOCs on primary residences. You guys have seen, I've done a number of different videos with Anthony in regards to this particular strategy. We've talked about how it can tie into infinite banking and things like that. Be sure to check out the channel so that you guys can get more information on that. I have a full playlist on infinite banking. I have a full playlist on HELOCs for real estate investing on my channel at Jamel Gibbs. Be sure to check that out so that you can find previous information on what we've spoken about. But generally, we talk about how you can use first lien HELOCs on your primary residence until now, right? So what's the benefit of using, let's talk about using HELOCs on your primary residence and how that ties in, and then we'll get into how that ties into the rental property stuff. So
perfect. So I'll do a quick synopsis of the strategy with a first lien HELOC on your primary residence, because that does tie into the investment property piece of it. If I skip that, and there are people who are on who haven't seen any of that, I think we'd be going too far, if that makes sense. So all in all, the first lien HELOC is a home loan, and it works differently than a mortgage. There are two main differences. One is how interest is calculated. The other one is how money flows. So money flow wise, a first lien HELOC, money can flow in and flow out freely. So you can put as much money toward the balance as you want. You can put all of it toward there if you want, because you can take it back out if you want. That's different than an amortized mortgage. You can't take it out with an amortized mortgage. So it allows you to leverage as much as you want. And so we know that. And so we leverage, or we understand that how that works. So we leverage that capability of this loan type. And so, and we do that to aggressively pay down debt. Our tagline, whatever you want to call it, pay off your home in 5 to 7 years. That is not beyond the realm of possibility, or that's actually kind of in line with the regular customer that we see in general when this works. And so essentially what you do is you drive in all of your income. We call it paycheck. Some people call it paycheck parking. Drive in all the income to pay down the balance as much as possible, as fast as you can. You do that because of how it calculates the interest. That's one of the other differences. Calculates the interest daily. So I don't want to wait 5 days to get my money in there, right? I want the interest. I want my money to go in there now so I can create a lower balance and pay less on interest costs today. I also don't want to put some of my money in there. I want to put it all in there because I don't want to create kind of a lower balance. I want to create the lowest balance possible to create the lowest interest payment possible today. And so you drive in everything to create the lowest balance as fast as you can. Once everything's in there, you then have to use it to pay your bills. So you pull from it to pay your bills, which increases your balance. So at the end of the month, you've driven in all the income, paying down the balance as much as possible. You pull out what you need for your expenses, that increases your balance, and everything left in there, every dollar of your surplus is still in there to pay down the house. So when there's a surplus, when there's a decent surplus, when there's a cash flow, right? When there's a good cash flow, every single dollar of your cash flow by default is dedicated toward paying down the house in real time, which means when you have one of these, there's no faster way to pay off the house. And so that's the absolute fastest way to pay off the home, to pay off the debt when you have a first lien HELOC. And so that's it. It's no more complicated than that. It's just new. And so that's the thing. So knowing that, when people cash flow, when they have, when they have a surplus every month, they can pay off their homes in 5, 6, 7, 8 years as compared to the regular 30 that we're facing with an amortized mortgage. So all in all, that's a quick synopsis of what we're looking at, right? And so when it works, people can pay off their homes really quickly. So now there are different scenarios in terms of when it makes sense to also get one on an investment property. Your first lien HELOC on your primary residence is going to be what we like to call the foundational loan. So that's your debt reduction hub, right? That's where you drive in income. That's where you use to pay your bills. So now we've got this investment property, right? I wrote down a couple scenarios. For instance, if I have equity available, if I have equity available in a primary residence property and I owe, let's just say $100,000 on an investment property, I get a first lien HELOC on my primary residence property, and then I get a first lien HELOC on my investment property. One thing to remember with the first lien HELOC is every single dollar of that line amount is available to you. The liquidity piece makes it, that's for an investment property, that's the main value add that this provides, because the liquidity that you get from having a first lien HELOC allows for you to leverage for other projects. So in this scenario, right, I owe $100,000 on my investment property, and I have $100,000 available in my first lien HELOC on my primary. I can shift all that debt. I can use the first lien HELOC on my primary to pay off the investment property. Yeah, we shift the debt to the primary, but now I'm paying this debt off much, much, much faster. And I get rid of the mortgage payment over here as well. So I owe nothing on my investment property, but I have access to the max line, whatever's provided to me, we can go to $1 million, right? And so what it allows for you to do is it allows for you to shift debt in this model, right? There are a couple of models that we can talk about. And so that's one, usually when we're talking about the primary residence, there's only one best way to do it. So it's easy for me to say, this is it. There's no better way, period, right? Once we get into multiple properties, it really does start to matter what your goals are and what your position is with each home, right? If you didn't have any equity in the primary residence, then we use the HELOC in the primary residence to pay that down quickly. But if you have equity in the primary residence, you can shift the debt from the investment property over here. If you were to do that with an amortized mortgage, though, you don't have access to any of the equity in your investment property. It's debt equity. Yeah, it's paid off, but you can't do anything with it. And so in this scenario, it allows you to safely completely pay off the investment property, so you don't owe anything on the investment property. But at the same time, you still maintain access to the equity in that home in case you need capital for a flip or another buy and hold. So it gives you the ability to leverage the equity in the properties when you have equity in a way that allows for you to access capital. So we're talking about immediate access using a checking account to $700,000 at 8%, 9%, which to me, I'm not investing as much as you are, Jamel, but if I think about access to hard money, it usually takes a little bit of time. And then right. And then you're also looking at I would imagine a higher rate than 8 or 9%.
12%.
12%, right?
Yeah, give and take. It depends on, obviously that depends on a lot of different factors, but industry standard is right around 12%.
Yep. Yeah. So I ran, before we hopped on, I wanted to be kind of prepared. So I ran a couple numbers. So we have to make some assumptions here, right? I have to make some assumptions about cash flow, if that makes sense. So the example that I kind of ran, so for one, the interest rate on a primary residence loan is going to be less than the interest rate on an investment property loan, right? So if we think about just a balance of 200,000, right? If I owe 200,000 on an investment property, let's say at 9%, and I owe 200,000, or I can shift that debt to my primary residence property at 7%, I would go from a $1,500 payment to a $1,166 payment, right? So right there, just from shifting the debt from one place to another, you get to save $350 in cash flow. Right.
So you're saying basically, if you were to take a regular amortized mortgage, that a regular 30-year mortgage, and you shifted it into the first lien HELOC, you're saving $350 a month, even at a higher interest rate.
Good question. I was strictly looking at the interest payment.
Got you.
Right. So if I've got an interest payment for $200,000 at 9 versus 200,000 at 7, I can increase my cash flow by $334 exactly. Right. Just from shifting the debt from one place to another. And so it gives you two separate liquid vehicles to move debt from high interest rate to low interest rate debt, just by the nature of moving it from one place to the other. And you never lose the liquidity. You don't lose the liquidity by doing so.
I want to mention one thing before we move on with that, because some people are just hearing about first lien HELOCs, how HELOCs work today, right? So what I really want you guys to understand, differentiate taking a 30-year amortized mortgage from a HELOC that you could pay off in 5 to 7 years. Basically the difference is, when you use a HELOC, it's like buying a car, right? They're using simple interest versus amortized interest.
Yep.
On a 30-year loan, the reason why it takes 30 years is because you're paying interest on top of interest, basically. So they're spreading that interest out over 30 years. So you're going to pay 2-3 times the amount that you should have paid on the property, right? So for example, if you take $100,000 loan or $100,000 mortgage out on a property, which is rare these days, you're going to probably end up paying $250,000 to $300,000 for that same property. If you did simple interest, meaning the same type of interest as if you were to buy a car, simple interest loan is going to have you paying a lot less in interest over the life of the loan, right? So
to add to that, with the simple interest and being able to pay it off in a much shorter period of time, it allows you to save tons of money in overall interest. So the first payment that you make with your amortized mortgage, roughly 73 to 74% of that payment goes to the bank.
That's right.
And the rest goes to you.
I think we worked out the numbers like 17 and a half years before before
it flips.
Yeah. Before you're actually paying more on the principal than the actual than interest.
Yeah.
Right. But
so,
with HELOC, go ahead, bro.
Yeah. So like you said before, Jamel, for those of you who this is a brand new concept to, just know that right now we're talking about 3 steps in, right? This conversation, this particular analysis is a little bit of a higher level type of conversation, assuming that you've watched it. Like you said before, Jamel has some really, really amazing, probably some of the best videos I've ever seen about first lien HELOCs. I might be on there too. I don't know, but I'm joking. But there's a lot of content in terms of the fundamentals of what this is. That if what we're talking about today, if you're not connecting with it, watch those first and then come back to this, because this can make a lot of sense once you've got that down. And so just so you guys know, if that's happening, we're not trying to go too far. It's just, we've got some good content. This is kind of a new idea too. So
absolutely. Before we get into it, shout out to Sylvia from Greenville, South Carolina. Shout out to Foxy Doll 78 from Savannah, Georgia. I just wanted to say thank you for joining us today, and we're gonna continue providing you guys with more detail. Let's get into it.
All right, so I'm gonna walk through a scenario that we had seen, and first I'm going to talk about the primary residence property, and then I'm going to talk about what they can do if they were to loop in the debt from an investment property as well, just to sort of compare the outcomes. So this person, they owed $300,000 on their house. They had 25 years left, and they had a 4% interest rate. So they had 25 years left. The remaining interest that they were going to pay was $175,000 to the bank. That's not including what they already gave the bank. That's what's left, right? So when we ran their numbers with a first lien HELOC, I ran it at a 7.5% rate, which most people, there's no way, right? Why would I ever change out a 4% rate for a 7.5% rate? Well, the question I usually ask is if there's a way it can save you a bunch of money, would you do it? And they're like, well, I guess I still don't get it, right? And so, okay, well, just bear with me, right? So if they use this strategy, driving in the income and using it to pay their bills, and they cash flow well enough, it's possible that they can pay off the home extremely quickly. So in this scenario, they paid off. They brought in $13,000 income, and they had $9,000 total spend, not including their mortgage payment. So that would have resulted, just with their primary by itself, that would have resulted in a 9-year payoff, and they'd have given the bank $120,000 in total interest, compared to the $175,000 that they would have given the bank at 4%. And the reason why it was so inexpensive is the reason why it was so much less is because their cash flow pays down the balance so fast that it overcomes the fact that there's a higher interest rate on the HELOC. And so that very fact allowed for them to save $55,000 in overall interest because of their cash flow and how this loan allows for you to use it. Well, they also had an investment property, and the investment property, they owed $150,000 on it. Okay. And so, so what we did is they used the primary residence HELOC to pay off the investment property to zero. Well, their mortgage on that investment property was $1,467. Well, now, instead of having $13,000 in income, they had $14,467, which increased the income that's going in, but their expenses didn't change. And so basically what that did is that sped up the payoff time for them to pay off both properties in 10.42 years. And they'd end up giving the bank $200,000 in total interest. However, the $200,000 total interest cost against that $450 total balance, right? Because you have the $300,000 from the primary plus the $150 from the investment property. That's a total of $450,000 total interest cost. $450,000 total balance would result in a roughly $200,000 total interest cost. We look at what we call the cost of funds, the total interest cost. How much is it going to cost you, and how does that compare to a 30-year fixed rate mortgage? Well, in this scenario, if you had a 30-year fixed rate mortgage for $450,000 and you gave the bank roughly $200,000, it would have to have a rate of 2.625%. Well, with that investment property, so all in all, like that cost is the same as a 30-year fixed rate mortgage at 2.625% for both properties, and now they're paid off in 10.42 instead of 25.
So again, just to reiterate what you're saying here. So you get to, let's say you got two properties.
Yep.
One is a primary residence, one is a rental property.
Yep.
What you're saying is you can pay off both of these properties in a little over 10 years, pretty much.
If the cash flow's there, yes. If the cash flow's there, you can pay them off in 8. You can pay them off in 5. Right. So it's amazing because it allows for you to shift the debt to the best place, right? Now, in this scenario, right, if all they did would be to pay off the investment property's mortgage, pay off the investment property's mortgage, shift the debt to the first lien HELOC on the primary residence, pay that down, pay it off in 10.42 years. Awesome, right? They pay $200,000 in total interest on that balance. That's the same as a 2.625% interest rate. Great. But when they pay off that mortgage on the investment property, now they're sitting on this huge property with a bunch of equity that they can do nothing with. That's where the first lien HELOC in this scenario makes sense on the investment property, because had they gotten a first lien HELOC on the investment property with the 150, once they shifted the debt over to the primary residence, they'd still have access to that 150 if they wanted it, or 200, or whatever the line is on that. And so what this allows you to do is be extremely flexible with two different liquid vehicles that you've got, right? And once let's just say they have $200,000. It's a $200,000 line on that investment property. They could use that. They could run it up by 100 grand to buy another buy and hold, create some more income, create some more cash flow. Once now they owe $100,000 on that, they could shift that debt over as well. So again, I know we're going down a number of different rabbit holes here. Bear with me, just because there are just a number of different ways that you can leverage this. So the goal for me is to be able to explain the different pathways that are possible to be able to leverage both of these together, if that makes sense.
Now, guys, listen, just be aware where we are on this live. There's some weather outside, so we might have some shaky internet going on. Just bear with us in that regard. But I just wanted to let you guys know that. And if you're picking up what Anthony is saying, the main benefit to using, one of the main benefits to using a first lien HELOC over an amortized mortgage is the liquidity that you'll get access to. So when you make a mortgage payment on a house, pretty much everybody here would understand is when you're making a mortgage payment, you're paying down the loan, but the money you're putting into the house is locked into the house. Even after you pay the house off, the money is still locked into the house. You got to refinance or take out a HELOC in order to be able to free that capital up or sell the property. What we're talking about here is using a first lien HELOC, and every mortgage payment that you make provides you with extra liquidity that you can use for other things in life. Say, for example, you make a mortgage payment of, I don't know, $2,000 a month right now. That extra $2,000 when you paid on a HELOC is freed right back to you. So it's almost like having a credit card, using your house like a credit card so that you can have access to the cash to be able to do other things with the money, like invest in more properties. You're talking about putting a rental property growth on steroids because you got access to all of this capital. Or flip, let's say you wanted to flip houses. Let's say you wanted to buy multi-units. Whatever the case may be, you'll have access to the money because now your house becomes your bank, or at least one of your lenders, in order to be able to continue to grow from where you are to where you want to go. So think about that, guys. This is not a new concept. Other countries outside of the United States use this concept to pay off loans really quickly. It's new in the United States because these banks, they want to keep you blindfolded to what's really going on behind the scenes. And if they can continue to milk you on 30-year mortgages, then they will. But this is where you smarten up and allocate your money in the right places. You're shifting the debt, like Anthony said, to be able to have access to liquid capital to be able to grow your businesses astronomically, right?
So another, again, like my mind is, I'm kind of going down different ways to different structures, right? There are so many different scenarios that are out there. Obviously we can't hit every one. Let's just say you have a rental property, you've got an amortized mortgage on it, and you've got a pretty high balance on that, but you've paid down your primary residence pretty well. You've got some equity in there, right? One thing you could do is get a first lien HELOC on your primary to get access to all the equity in your primary residence. Now, you may have a low balance, but you can access a high line amount, right? So, which means you've got a lot of free equity that you can leverage if you want. Well, if you owe a lot on your investment property, you could shift the debt from the investment property to your primary residence. yes, it feels like you owe more on the house. You don't owe any more debt. It's the same
Mm-hmm.
amount of debt. You're just shifting it from a worse place to a better place. And then by getting a first lien HELOC on your investment property, you gain access back to the equity on that investment property as well. So with each scenario comes different ways to be able to figure out what's the best option for what you're trying to accomplish with the scenarios that we have, with the different factors that are available. I mean, I can do up to 2 rental or second homes. So if you have a second home and you have a rental property and they're paid down, you could gain access to that equity. If both of those have high balances and your primary residence has a low balance, you could shift the debt from those 2 to the primary to pay that down quickly while still maintaining access to that over here. Even from a purchase standpoint, if you have equity in the house, you could get a first lien HELOC on your primary residence to access capital to start one of your first deals. You're going to want to make sure that the first lien HELOC strategy works before you do that. That's the first thing we always do, is we answer the question, should this person get this loan, before we even talk about can they get it? Because the reality is, Jamel mentioned earlier, it's kind of like a credit card. It's a huge line of credit. I try and stay away from the credit card analogy, just because sometimes it had, sometimes it's got a bad rap, right? But he's not wrong, right?
Mm-hmm.
It is. It's a very, very big line of credit. And so for people that have challenges managing small lines of credit, it wouldn't make sense for them to have a very, very large line of credit, but for those, of us who were able to live below our means, make more than we spend, those kind of things, then you have the access and the upside of having a really large line of credit at a great interest rate in a way that you can leverage to make moves that maybe you wouldn't have been able to otherwise.
That's right. That's right, man. Country Boy 87 from Atlanta, One True Soul from Utah, Kevin Bond from North Carolina. Shout out to you. Listen, make sure you guys leave your questions, and I see a couple questions coming in, but make sure you guys leave your questions in a comment section, in the chat bar there, so we can get them answered in just a short period here. Also, make sure you like this video and subscribe if you haven't already. Looking forward to continuing to grow this channel to provide you guys with the content that you need. So what's the main difference between, let's say, getting a regular mortgage on a rental property and using a HELOC to buy a rental property? What would be the 2 differentiators there?
So for one, it's an interest only payment.
Mm-hmm. So which one is the interest only payment? Which one?
Good question. A first lien HELOC has an interest only payment. Mm-hmm. Your investment property loans are going to have amortized mortgages are going to have a principal and interest payment, which can help from a cash flow standpoint. If you're someone who knows how to manage interest only loans, then they can be really beneficial. The reason why I say it like that is because it's an interest only loan, it doesn't force principal pay down like an amortized mortgage does. I'll bash amortized mortgages all day long. I don't mind doing that. They do a really good job of setting themselves up for that to happen, because from a numbers standpoint, they're not set up for the client's best interest. They're set up for the bank's best interest. That's okay, right? One thing they do, though, that you can't ignore is they force principal pay down. They force wealth building, right? So for people that need that, principal forced payment to be able to pay down the balance and build wealth, it's a good thing, right? I can argue that it's one of the main reasons for wealth building in the United States, right? Mm-hmm. So I can't ignore that. But for people that don't need that, there are better options out there. And so it's an interest only payment, which means that you can save money, you can cash flow a little bit more, because you're not forced to pay a principal portion of the payment. That's one piece of it. The second is liquidity. which, we're going to keep coming back to this, which is as you pay down an amortized mortgage, you lose access to every dollar that you put toward it. It's gone. You can't get to it. You can't get to it right away. And you're right. You can do a cash out refi.
Mm-hmm.
You can go get a HELOC later.
Sell it.
You can sell it, right, to get access to the equity. But every dollar you put into it, you lose access to. And so with a HELOC, that's the second main difference, which is that every dollar you put toward this to pay the principal down, you don't lose access to it. You can take it back out if you want, which means that it gives you a place to store capital that works for you while it's stored there. You can choose to store your capital a lot of places. One is a savings account, checking account, high yield savings, right? We can get 3 or 4%. While your money's stored in a first lien HELOC, which is another place to store capital, it works for you by offsetting the interest cost that's associated with that. So it saves you money. It doesn't make you money. It saves you money. But from a bottom line standpoint, it's the same. And it allows for you to pay down debt if that's what you're trying to do. But if a deal comes up, if an opportunity comes up, you can pull it out right away to invest that money if you want to. So those are the two main differences. And I would say advantages that the first lien HELOC has over an amortized mortgage in terms of investment properties as well.
I was going to say too, if you guys want to see a breakdown of, because can't remember which video it was, but definitely go through the First Lien HELOC playlist. We provided a breakdown of what it would actually look like if you were to spend 30 years on an amortized loan versus, the time frame it would take for you to pay off the HELOC. I think we did it at like 7 years or something like that.
Yeah.
And how much money you're actually saving.
Yep.
By simple interest over amortized interest. So,
yep.
Imagine doing that on multiple rental properties. There's a concept out there called, and I'm sure you're familiar with it, buy, borrow, die, right? So you buy a property and you keep it forever and you pass it down. But what you're doing is you're borrowing from it through your HELOC, and you're using the HELOC money to continue to buy more and more investment properties. So the more properties you have access to right now, or you plan on buying, the more money you'll have access to through the first HELOC. Now, how many properties can you actually do this on as of right now?
So I can do it on 3. We've got a foundational loan with the primary, and I can do 2 others. I can do I can do investment properties and second homes, and 1 to 4 unit. So multifamily. So single family to 2 to 4 unit multifamily. I can do condos. I can do PUDs. We can do townhouses. I can't do non-warrantable condos, and can't do manufactured mobile or modular homes. So yeah, that's what we've got at this point.
And you can't do multi-family above 4 units because it has to be residential.
That's right. That's right. So residential mortgage guidelines, you can go up to 4 units, but once it's more than 4 units, it's considered a commercial loan, not a residential loan anymore. So that would be on the different side of the bank, if that makes sense. But yeah, we can go up to 4 units at this point. Used to be you had to live in the unit, but now it can just be a 4 unit, 2 to 4 unit investment property as well.
Like a house hack type of situation.
Like a house hack type situation, right? So, before, if it was a house hack and you're living there, we could do it. Now I can do it just straight. You can live in your own primary residence. We can get your fourplex done on its own. So Perfect. We can do a total of 3 loans, 1 with your primary and then 2 with your investment.
Is there a certain amount of equity that you need in the property before you can do these first lien HELOCs?
Yeah. So for your primary residence, I can go to 90% loan to value. So you need 10% equity. With investment properties, we can go to 80%. So you need 20% equity in the house. Yep.
That's fair enough. And if you guys are buying properties the way that I show you on this channel, we're buying at a discount anyway. So typically we're paying 70 cents on the dollar for a rental property. By the time we put the money in and we want to refinance out, I mean, we're at 75, 80 cents on the dollar. So you guys should always have that 20 to 30% equity in the property on the purchase because you're buying at a discount. You're buying in distress. So you should automatically qualify for one of these, which is perfect. Now, do you guys have plans on expanding out past the 3 loans at some point?
I'd like to. We were able to convince the board to move with this, and just like anything, it just needs to prove itself. It needs to prove itself to them as an asset class in a way that they feel comfortable with it. So this is sort of the intro to it. And I definitely would love to, the plan is to expand. Just got to get the right people comfortable with it, if that makes sense, and have the asset prove itself out in a way that's safe, in a way that they're comfortable with, before we start pushing the envelope with it.
Yeah, man. And literally this week, you guys are rolling this out. So you've heard it. You've literally heard it here first. I'm not sure if there's another product out there with a first lien HELOC on rental properties right now, but you've heard it on this channel first, like a lot of other things as well. But listen, the way I see the benefit in this is you utilize all 3 of these properties, all 3 of these first lien HELOC loans. You got 1 on your primary, 2 on rentals. Now you have the access to the cash. You use the cash to buy properties in cash, and then you convert those properties out. Use the long-term loans from that point forward. So now you have access to your own cash. You get all your money back out when you refinance, and at the end of the day, now you can build cash flow and passive income, which is a huge thing that I teach on this channel, just by using long-term bank loans.
So that right there is, you just hit on something that I think is big, which is that for anyone who has watched our Jamel's videos on velocity banking and using a first lien HELOC, and I've said this a couple of times. So I've used the word surplus, the word cash flow, right? Money left over at the end of the month, right? Whatever you want to call it, right? This whole concept is about balance manipulation. It's about paying your balance down, because that's what allows for you to save money. And so that comes from surplus. So anytime you have a property and you pay off an amortized mortgage and it's gone, you automatically increase cash flow by the amount of that mortgage, period. And so even though you're shifting debt from, say, an amortized mortgage or from an investment property to a first lien HELOC, the amount of debt doesn't change holistically. It does on one place, it goes away from another. But holistically, it's the same amount of debt. But what you're doing is, when you get rid of that amortized mortgage, now you get rid of that full payment, which means now that increases your cash flow, which speeds up the pace by which you pay down the debt on this side. So you can stack that in a way where you pay off one property, then you pay off another one, and your first lien HELOC, your hub, your primary residence debt reduction hub, pays down debt so fast that now you can just knock out these properties a lot faster than you could have otherwise, because every property you pay off increases cash flow by $1,000 or $2,000, whatever the mortgage payment is. And so that enhances how quickly you pay off the debt with the first lien HELOC. That to me is a huge value add if you have multiple properties,
Yeah, man. And a lot of times people get started in real estate with very little capital. This is an opportunity, again, if we're using a burr type of deal as an example, you can literally, like I've been investing for 25 years at this point, and I can't count on one hand. Well, I could count on one hand, probably 2 fingers, how many times I've actually put any type of money into the deal, like $100 or whatever, right? But the point is, I can use private money to burr out a deal, get the equity. Now I can take that and go first lien HELOC, or I can just, if I have a house that I'm paying a mortgage on anyway, convert it into the first lien HELOC. Now I have access to the cash. So rather than renting, I know renting is becoming a popular thing these days, and that's perfectly fine. But with renting, you don't have equity, right? So you're going to have to find another way to save the money up to be able to buy the properties. If you own houses, or at least one house, your own primary residence, you can convert that into a first lien HELOC. Now you have access to the money.
Yep.
Right. You take the money you go ahead and you buy a rental property. Now, once you get the rental property, you do a first lien HELOC on that one. You do it another time. Now you got three.
Yep.
Now you've accumulated enough capital to do exactly what the plan was that I laid out a few minutes ago. Buy a house cash, refinance it into a long-term BRRRR type of deal, build the cash flow, always have access to the money locked into your house, and you get to pay these properties off in 5 to 7 years. You know what I mean? It's a win-win situation. And this is how you can do it with no money out of pocket or very little.
Yep.
You know what I mean? So you just got to think outside the box. This is not new. They're doing it in New Zealand, in Australia, in other countries. They're just not doing it here because the banks want to rob you. Period.
Not my bank.
He don't want me to say banks robbing people, but that's what they're doing. They're stealing from you, man. They're taking your money. And even though this is an interest-only loan, hard money is an interest-only loan. I want to point that out. Whenever you borrow money from a hard money lender, you're only paying interest on that loan until you pay the money back. All right. This is an interest-only loan, but you own the asset. What's the benefits of that, Anthony?
Well, I would say that having a sense of security because it's secured by your home. The loan itself gives you a little more security itself. I think that it gives you the freedom to leverage at any given point in time. I don't know how long it takes you, Jamel, to get hard money, right? But this can be done through a wire, right?
That's a great point, man.
Like it's immediate, right? Which doesn't mean you don't want to go and be frivolous with it, but if there's a deal and you need it done today, you can get it done today with a wire. You can write a check, right?
Yeah.
I mean, it's got a debit card attached to it, and so the immediacy that you have with access to the money is different than even with hard money, and even hard money that's fast isn't immediate. You still have to go through some vetting, right? And so this gives you access to it immediately. And also because it's secured by your real estate, the interest rate that you're going to pay is going to be lower than an unsecured loan that's even based off of the deal that you're getting, right? With hard money. So with hard money, from what I understand, you show them the deal, they understand that it makes sense, there's enough meat in the bone, and they lend based on that and some of your credentials as well.
A lot of times with hard money too, you got to go through the process of getting an appraisal. You got to get a contractor's inspection or contractor's estimate, and then 2 weeks later they'll close it. If you have a relationship like me, it can be done in 3 days. But with this, you're vetting your own deals and you're cutting a check out of your own primary residence. The reason why I would still vet the deal properly, I would treat the money as if it's hard money.
Yep.
The reason why I would do that is to make sure you have yourself a solid deal. So it may be beneficial for you to still get an appraisal. It may be beneficial for you to still get that contractor's estimate. So you're vetting it as if it's hard money. This way you're protecting yourself and you're protecting your money that's locked into the deal. Right. But the point is, you can strike a check, you can cut a check the same day. You don't necessarily need to wait 2 weeks or 21 days or 30 days. And this is going to help you get way more deals than the average investor in the long run. You got access to the money right on the spot. They got to wait. If they're getting a loan, they got to wait 30 days. They got to go through the whole process. You can be like, I'll buy it today. Just as long as your title company or attorney can send me a clear title, which might take 3 days.
Well, how many other investors are you going to have?
Nobody.
Have an advantage over just by
very little, man. Very little to be able who have access to the type of capital. Very little, because most people are using other people's money, and that's perfectly fine, But again, it just gives you more power and it allows you to grow your wealth.
The way I like to think about it is it's another option in line with everything you've already got. I don't think it's the right option every time. I'll tell you that up front. Nothing is the best thing every time. Nothing, right? But what it does is it gives you another option. It's immediate and it's at a better interest rate than any other quick money that I'm aware of that you can get at that scale, $1, $2, $3, $400,000. So to me, it seems like another option that's available that for a lot of reasons could be better than the ones that are already there.
And you're using your biggest asset as your own bank. You're using your biggest asset. You know, if you live in a house, you can use it as a bank to be able to, all the money that you're putting into it, you can pull right back out to be able to reinvest. It just makes sense. Again, it's not for everybody, but to me, it's for everybody.
You can say that. You can say that.
You can't say that. I can. Listen,
you can say that.
If you're smart and you know what you're doing,
yes,
and you have the right guidance, which is definitely a major key in it, you can move strategically and really,
yes.
You know, there's no way you're going to save up $1 million, but you can get access to $1 million because you're already paying into it anyway in your own house. Get access to the money that you're already locking into a 30-year loan.
I talked with someone and he said it well. He said, your money shouldn't be tied up in your 2x4s. And that's what you're doing. What he meant was that when you have an amortized mortgage and you put money into the house to pay it down, your money's stuck in that 2x4 and in that 2x4 and in that 2x4, and you can't take it back out. And so that was a good way for him to sort of explain it. I'm taking it, but he said that, you know, why have your money stuck in the 2x4s? You want to be able to have it be out in the market working for you. Now, once you sell the deal, if it's a flip and you sell the deal, you put it right back in.
Yep.
You put it right back in. You do it with everything because you know you can take it back out again. So it's the liquidity piece. I know we keep coming back to that, but that's a huge advantage that it gives you over an amortized mortgage. And if you have that on 1, 2, 3 different properties, now you have access to a lot, 3 times the amount of equity, if it's the same amount, to be able to leverage for future growth.
Right, man. So, and that's actually a great point as well. So so you can do 90%, right? So let's say, for example,
on your primary.
So on the others is 80.
Yes.
So let's say that you owe 70 cents on say 70%.
Okay.
That means you have access to 10% of the equity.
Means you have access to 10% of the equity.
Got it.
If we're going to 80%. Correct.
We're going to 80 on a rental. So if I owe, so let's say, for example, I have a $300,000 home. 70% of that is what, 210?
210.
So 240 at 80%. That means I got the difference between that two. I got $30,000 that I can pull.
That's right.
Nice. And then if I owe, let's say 150 on a primary, but it's worth 600, I can pull up to 90% of that,
which is 540.
540. So 540 minus, let's just say, I don't know.
540 minus 150 gives me 390.
390. So just between those two properties, you got access to $420,000 in capital.
Yep.
How can you lose, man?
That's a lot. I mean, the way I like to think about it is regular people don't have access to that amount of money. So I'm a regular person, right? So having access to that immediately is not something that just happens unless you're wealthy, unless you are born into wealth. And so this can give you access to the amount of money that investors have, that they come in and they beat you on their deals because they've got access to it right away.
You know how many people I talked to that bought a house in 2019 and gained so much equity because of the pandemic?
That's a good point.
You know how many people I talked to that inherit houses with no mortgages on them?
Yep.
You know how many people I could go down the list, man. There's money. You guys have access to the capital. You just got to do the right thing. You got to know how to get the money out so that you can invest the right way and really, this is just going to catapult your finances. It really is. You just got to, scared money don't make no money, y'all. Scared money don't make any money. You got to get out there. You got to be willing to pull it out. You got to be willing to invest it. keep the money moving. If it's sitting in your house, it's dead money. Dead money don't make no money.
Sure.
Right. If you use a HELOC where you can continue to circulate the money, money is meant to be circulated. So you can make a whole lot more money on top of your money. Now, obviously, educate yourself, because just the same way you can get it, you can lose it. Right.
Yep.
You don't want to lose it. We're not in a losing game. And that's the beautiful part about what Anthony does. He vets you to make sure that you're in a position to be able to do it. He's not just some mortgage broker who's going to tell you, yeah, let's go do the deal, close it, and then you're stuck with the house. That's what I love about this program. They vet you. They make sure it's going to, like he just said, it's not for everybody. He's going to make sure it's suitable for you.
We do. And part of that vetting, part of that conversation that we have, I mentioned before, we answer 2 questions. Should you do this, and can you do it? And we don't look into can the person get the loan until we answer the question, should they even get it? Is it a good idea? And we look at your balances, and then we look at the cash flow, because the one factor that makes this work is cash flow, is the household's habit of living below their means, the household's habit of making more than they spend, and being able to do that consistently. And so I would love to say that's one of the things. That's the thing. There's nothing else. There's nothing else here that makes it work, because the only way you pay down the house is by using the surplus. Mm-hmm. And so when the household is living month to month, when they're struggling with their bills, there's nothing wrong with that. But I do know that this will not be a benefit if that's the case, because this works when there's a surplus. So it's important to know that. And we answer that question. We look in, we ask the questions of what's your income look like? What do your expenses look like? We have a calculator that we run. I've got 2 loan officers who specialize in this, and they've done this for 6 years now, and it's all that we do. We don't have any other kind of loan. So we have these conversations with people day in, day out, probably 6 to 7 people a day. And so that's the vetting that we do. Conversations usually last about an hour, and we go through that whole process first before going into what's your credit score look like, those kind of things, just to make sure that when we're talking with someone as we move forward, that we're really confident that this person is or that you're someone who this will not hurt. That's the last thing that I would want, is for the wrong person to get into this and then they get hurt, and having us be part of that. And so our goal really is to make sure that when we talk with you, we'll ask questions about your income, your expenses, what's that look like? We'll run the calculator with your balances to see how fast could you pay off the house. And the sort of, that's sort of our litmus test, if that makes sense, to see if this would be something that would be a good fit for you, because that's the most important thing that we need to find out. And then we'll help you with all the first lien HELOCs you want if it's a great idea, because if it is, a lot of times the question that we get after that is, where do I sign up? Because it's that powerful.
Now tell them what the failure rate is versus the success rate, man, because you guys are going to find this to be phenomenal. What's the failure rate because you vet people before they actually get in?
So just I looked these up. So over the past 6 years, we've done over 2,000 first lien HELOCs. We've done over 845 million in originated loans. 14% of those have paid off their first lien HELOCs, completely paid them off. And we have an average of 11% pay down per year, which tracks to a projected 9-year payoff. So our average customer is going to pay off their home, according to the average, is going to pay off their home in about 9 years. We've had one default out of 2,000.
How many?
One. And and I don't know what I'm supposed to say. It's a fraud case. So like even then, it's like they didn't fail because of it. Now there are people who right, and so like we don't play around with the vetting piece, right? Because I don't want people to fail. And just so everyone here knows, even if we didn't care, which we do, but even if we didn't, let's just say we had a bunch of defaults because we didn't originate this in the right way. We didn't vet people. The bank would shut the whole program down real quick, and I wouldn't have a job. So there's that piece too, which is real. So even if I was full of it and we actually didn't care about people, all I need is for there to be 4 or 5 defaults, and we're done. So the good thing is I don't have to be telling the truth. I am, but I don't have to be, because if we didn't do it the right way, we wouldn't exist either. So yeah, I mean, the thing is, we do look for people who we believe are going to be good fits. Sometimes they're people and they get in and the discipline, or that they don't hit that habit as much, right? And their balances are increasing. There is a point at which we call and say, hey, look, it looks like your balance has been increasing month over month over month over month. That's the opposite of the direction that we really want to go. And so we have a conversation with them about their expenses, about their income. Did something with their lifestyle change? Are they not making as much as they did before? Did they just kind of get, a little more lax? Now they're spending a lot more money. What's the root cause of it? And to try and help them get back on track so they can succeed to pay it down. So all in all, our goal here is to improve people's lives. That's what we do. That's what I do. I wouldn't be doing this if that wasn't the outcome, because that's my goal in life. So we want to improve people's lives. And so it's not about getting a sale. I don't know if proud's the right word, but like I'm happy and we've hit some pretty amazing goals that I'm really excited about for our team from a numbers standpoint. But it's not that's not what gets me excited. It's the fact that 14% of the people who got them have paid off their house. It's that instead of taking 30 years on average, it's going to take our clients 9 years to pay off. That's exciting. And so that's what gets me motivated. It gets me up in the morning. That's what gets me going. But it does mean that we have the responsibility to vet in that way as well.
And this is why I surround myself with good people. Everybody I bring on this channel, you guys can see they're just good people. We all do business together. We do what we say we're going to do.
Yep.
And we're really just here to help you improve your situation. We appreciate you guys watching the content. And in exchange, we provide you guys with value that you can really use in your business. There's no fluff, right?
Yep.
So that's something that, I take pride in myself. And that's what I want to be known for in regards to finances and education in the business world. I want to be known as a guy who does what he says he's going to do and provide value to people. All right. So, but that's what it's all about, guys. There's a lot more that we can cover. What's some of the qualifications to get in one of these first lien HELOCs?
Yeah. So you're going to want to have above a 700 credit score. Property type, 1 to 4 unit properties. I can do condos, townhouses, PUDs. I cannot do modular. I can't do manufactured. I can't do mobile homes. We can do all states except for Texas. I can't do Maryland. I can't do Hawaii or Alaska.
You can't do Maryland, you said?
I can't do Maryland.
Hawaii and Alaska?
Hawaii, Alaska, or Texas.
Or Texas. So those 4 states you can't do at the moment.
Correct.
Okay.
So the minimum balance I can do is 100,000.
Mm-hmm.
Now, if you owe, let's say you have an investment property, you owe $85,000 on it. When we close, we can also pay off other debts that you have to get up to the 100,000. So we can make it so that the balance on that HELOC can hit that minimum. There are different ways that we can do that. But that's a minimum of 100,000. Max is $1 million line amount. And it's going to be a full doc underwriting, which those of you who've been through mortgages before, if you're self-employed, mainly if you're self-employed, you know what full doc means, because we're looking at tax returns and your bottom line, which people who are self-employed, a lot of times, if they do a good job with their tax returns, you don't show Uncle Sam you make a lot of money. And if that's the case,
Don't say that too loud.
Yeah. Well, you should. That's hey, within tax code, real estate's one of the strongest tools I've ever seen for that here in the States. So yeah. So I mean, credit score 700, and $100,000 minimum loan amount, 1 million max line amount, and then states wise, Texas, Maryland, Hawaii, Alaska. Those are the main things.
Nice. And how can our listeners get in contact with you, man? I'm going to leave, and by the way, I am going to leave a link in the description box so that you guys can, as a matter of fact, if you look below this video, you probably see it right now, but I'm going to leave a link in the description box so that you guys can get access to the calculator and be able to contact Anthony. But how can our listeners get in contact with you?
So you can go to firstlienheloc.com. Well, actually, no, don't do that. Don't do that. Use the link down below that Jamel gave you, because what that'll do is that will book you with a call with one of the loan officers on my team. I'm not able to originate. I'm not off limits, just so everybody knows. But because I can't originate, my role is more to educate, to advocate, to manage the team, to make sure that they are in step with how we do things, if that makes sense. And so the link below that Jamel has down there will bring you to a calendar page to book a call with one of the team members that we've got as well. If this concept, this idea, if the velocity banking or the first lien HELOC strategy that we've been talking about, if this is new, definitely go watch the other videos first. The reason why I say that is anytime someone books a call with us, it books an hour slot with the loan officers. So it's going to be really helpful for you to sort of self-evaluate, to learn about this first, and watching the other first lien HELOC videos that Jamel has, that's going to be a really important step for you guys to feel confident and comfortable with what this is. So then when you do book the call using that link below with one of the people on my team, you have a basic fundamental understanding of what this is. If you've got it and you want it and you know you want to move forward with it, with your primary and with an investment or with two, then just go ahead and book the call. And then we'll, again, vet real quick. We'll re-educate, just make sure that you understand the ins and outs of it, and we can help get you moving forward with it real quick as well.
And I'll say this as well, at the end of the day, the vetting process is for your benefit. You don't want to lose your property. So, when you go to Anthony, if you don't qualify right now, he'll tell you how you can get qualified. All you got to do is put in a little bit of work to make it happen. But, just know that it's for your benefit. We don't ever want to get you in a position that's going to harm you. We're here to help you, not hurt you. So in order for us to help you, for some people, it's just not going to be the right product right now. But that doesn't necessarily mean you're not going to fit the bill later on.
I agree. And what can happen, Jamel, is that traditionally when people don't get approved for a home loan, I found that people feel like it's done and it's not going to work ever. And I'm not this first step, the vetting process, is not about getting you approved for the loan through the bank. It's about, is this a good idea for you right now? And that's a more important question. Even when we get to the next stage of, can we get you approved for the bank? Our philosophy is one where it's like, listen, there's always, no matter what, when there's an obstacle, when there's a challenge, when there's a problem, it's never the end of the road. There's always a solution. And so the solution may be one that's really easy. It may be really tough. You may like the solution. You may not like the solution. I can't control any of those. But what I do know is that when there's an obstacle, if the initial vetting shows that this loan's going to, result in a 25-year payoff for you, it'll tell you, hey, look, this isn't the best idea for you. All that means is that we need to work on our cash flow to improve our cash flow so this can work, if this is what you want to do. If the credit score that someone, the credit score that's pulled, if it's lower than that, for primary residence, it's 680. For investment property, it's a minimum of 700. If it's below that, it can feel really disheartening because our credit, because the credit score is too low and we get denied. We feel like we're denied, and that feels like a very hard and fast forever thing. That's not the case. It just means your credit score is too low right now. Like, we can help. I can give you some tips on how to improve it. We get it up and then we try again. And so, the reality is that, Jamel's right, where those vetting, the vetting process that we go through is not to insult and not to hurt you. It really is to make sure that this is something that you're a good fit for, and that with your lifestyle and with your practice and with your habits right now, that it has a high likelihood of improving your life, because that's what we want. Because you can use this like a credit card and you can abuse it like a credit card. But instead of abusing a $14,000 credit card, you're abusing a $200,000 one. I don't want that. I don't want people to be in that much debt because I helped them get into a loan that I could have figured out wouldn't be a good idea for them on the front end. And so you're completely right. The vetting piece of it is not a judgment. It's not a denial. It's not you should never get this. It does mean that something within that, the different factors that we learn don't align with what this needs for people to be successful. And there's nothing wrong with that. It's just a matter of understanding what those are. And if you want to go this route, we can help you figure out what those things are.
That's it. I want to share something with you guys as well. How to use HELOCs for real estate investing. There's about 18 videos in there. That's literally probably 18 to 20 hours worth of information in there, because every time I talk to Anthony, we're on the phone for at least an hour. That's 20 hours of information on how this whole strategy actually works, right? The rental aspect of it is brand new. He's launching it this week. Again, I don't know of anybody else who's offering something like this. Be sure to reach out to him, get some more information. But if you want the overall generic idea of how, first lien HELOCs actually work and what it takes to qualify for one, check out those videos. It's a masterclass on first lien HELOCs. And now we're just adding to the equation with the rental aspect of it as well. So you guys will be geniuses when it comes to first lien HELOCs after watching those videos. Trust me. In the meantime, man, let me go back to the screen here. Let's take some questions, man.
Yeah.
You got a couple minutes?
Yeah, absolutely.
Perfect, man. So let's first and foremost, again, shout out to everybody who decided to stay on to the very end. We have a question from, I'm gonna call you Naya. She says, I just want to ask, am I able to take out a HELOC on my home with a mortgage balance still? I was told that I couldn't do that because I'll have two mortgages. That's only if you're getting a second lien HELOC. But Anthony, go ahead, brother.
Yeah, I think that's probably what that's for. So I was told that I couldn't because so basically we could take a HELOC out, first lien HELOC out on your primary and investment, if that makes sense. And then you would have two. It depends on the reason for why they said it'd be a challenge. So if the problem was that, or if the challenge was that the income that they were using for the file, if the debt to income from having two mortgages at the same time was too high against the income that you had, then you might run into a similar challenge, but we really wouldn't know until we get it in. But all in all, there's nothing stopping you from getting two mortgages at the same time. So yeah, you could definitely do it.
Cool, man. Kevin Bond, he said, what type of equity do you need in order in the property to take out a HELOC? Now, I think we kind of covered that, but you want to reiterate it?
Yeah. So for a primary residence, you need 10% equity, because I can go to 89.9%, which is roughly 90%. And with an investment property, you need 20% equity minimum.
Now, let's just say, for example, somebody has 10% equity and they roll it into the HELOC. How do they get access to capital at that point?
So if they have 10% equity and we get a 90% HELOC, that means that they have a 90% mortgage on their house. So we use the HELOC to pay off the full mortgage, which is 90%. At that point in time, you would have a maxed out HELOC because you wouldn't have any access because the balance is now paid off the mortgage. The way that you gain access to the equity is by aggressively paying down the home. So down to 80%. At that point in time, your limit would be a 90% loan to value, which means you'd have access to the 10% that you created by paying down the debt.
Good stuff, man. So again, if you watch the videos, you'll see how you can aggressively pay down the HELOC. It's not difficult at all because you're literally going to live off of the HELOC, right? So let's say you get a paycheck. You want to just give them an analogy real quick?
Yeah. So, so let's say you owe $200,000 on the house, and let's just say I'll provide a simplified version, but let's just say you bring in 10,000 a month and you spend 7. Okay. So you start at 200,000, and the strategy that you implement is you drive in the income that pays down your balance. You pull out what you need to pay your bills, that increases your balance. And so month 1, you start at 200,000, driving the income of 10,000. That brings your balance for 200,000 down to 190. Now, throughout the month, you use your HELOC to pay your bills. You pull out 7,000, which is the bills for this month. So you drive in 10, you take out 7, you still have $3,000 in there. So at the end of the month, your balance is 197, right? Which means you still have $3,000 of that 10,000 that you first put in there, right? You still have $3,000 in there. That's your principal pay down for that month. Next month, drive in 10,000, which brings it down to 197 to 187. Well, then you pay your bills of 7,000, which brings it up to 294. Next month,
let's say somebody's not making 10,000 a month. Say they're making 5.
So you're making 5, right? So again, it just depends on the amount of surplus. So let's say you're making 5. Now you have
you're only spending 3.
You're only spending 3, or you can just, you're spending 3, right? So if you owe $200,000 on the house and you drive in 5,000, that brings it down to 195, and your expenses are 3,000, which brings it up to 197. No, that's wrong. 198. I'm sorry. Come on, Anthony. You're at 198. So you've paid in the house by $2,000 that month. Next month, down by 5, up by 3. You're at 196. Next month, down by 5, up by 3. It looks like this sort of jagged step down, right? Where it goes down by a lot, up by a little, down by a lot, up by a little, because that's what happens during the month. And so every dollar that you pay down, so this household would be paying down their home at a pace of about
$2,000 to $3,000 a month.
$2,000 to $3,000 a month. Let's say they owe $200,000 and it's $2,000 a month. That's 100 months, which is an 8.3-year payoff.
And again, just to clarify, that takes care of all of your. Let's say that you're living. All right, so let's use real numbers, right? The average American household is paying about. I did the math the other day. It's about $6,500 a month in expenses. That covers mortgage and car payments and food and everything, healthcare, everything, right?
Yep.
Mortgage too. That's everything. Yeah, $6,500. That was the average. Obviously, some of us are paying more, some are paying a little less, right? So $6,500 a month. Now, the average person is making about $60,000 to $80,000 a year in a household. So if we take $80,000 divided by what is that? 12. What's the math on that? 80,000 divided by 12 is how much?
I don't have that right now. Hold on. 6,666.
Yeah, so that means the average American right now is living on every dollar that they basically
Right.
they that
They are.
that that they make. You
Yeah.
know, so this if you're making, let's say, $100,000 a year, then this changes. You know, because then you're
Yeah.
up to what is that, 100,000? Let's say you're
Uh,
in a two-person household and both of you guys are making 50,000 a year, which is definitely realistic, by
yeah.
the way. So
Just
$100,000 divided by 12, you're at 8,300. But if you're
83.
only spending 6,500, then you're basically making an extra $2,100 a month that you could be using to pay down your mortgage. That's what we're
Right.
trying to convey here. Okay.
Yep. And with that surplus, what people will not do, because it's not safe, is they won't take that surplus and put it toward their mortgage every month. They
Right.
shouldn't do, because it's locked away. You can't get it. You should not do that if you have an amortized mortggage.
Most
However,
people do that to save, they put it in a savings account. You know what I mean?
savings account, right? And so here, that surplus can be dedicated toward paying down the house safely,
Mm-hmm.
because you still have access to it. And that's the main difference in terms of the fundamental strategy here. It allows for you to leverage every dollar of your surplus to use every dollar of that you don't spend and put it toward paying down debt, which means when you have this, there's no faster way to pay it down.
Right. And when you do have to pay your bills, like Anthony says, you got a debit card on the house, pay the bills. That's part of that
Yep.
$6,500 that we just used as an
Yep.
example. Right. So if you're used to going out to eat with your wife or your husband or your family every Friday, that's part of that. You know what I mean? So you just
Exactly.
take your expenses, you live off of the house, and you still pay down
You
extra.
live off the house. That's a good way to put it.
You know what I
And
mean?
you gain the benefit of doing that when you make more than you spend, when you live below your means. But
Exactly.
again, it does require a fair amount of surplus.
Yep.
And so that's just a reality with this, which is that it does require a fair amount of surplus. So the habits that the people that succeed with this have are ones where they do make more than they spend, that kind of thing.
You know, somebody said it best right here. One true soul says spending habits, self-discipline. I love that, man, because that's the essence of what you need in order to be able to make this happen. You know what I mean?
That's it.
Um, how to learn more. This is from Sylvia Lyles. How to learn more about the HELOC. You know, again, you can contact Anthony for a consultation or
Yep.
go to my channel. I just showed you guys how to do that.
Yep.
And just watch the entire playlist. I'm talking about a masterclass on this stuff, detailed. And like Anthony said, it's the best. You know what I mean? It's the best on YouTube. I haven't found anything better than
I
it.
haven't found anything better either, Jamel. It's a but the funny thing is, I did chat GPT, who's the
I
best
said me,
person,
man.
who are good people to look up for first lien HELOCs, and your name actually populated to that. So
Good
hey,
stuff.
look, even they know you. So yeah, I would say that that those resources that Jamel has on his channel are really, really good. The conversations that we have go down different scenarios that I think
Right.
are going to be really great. You can reach out to us. Our capacity is not one where we have hours and hours and hours, if that makes sense. So do that homework first. Take a look at it first. And then what'll happen is, once you've got a strong understanding, it will you'll be able to you'll be able to have mid to higher level questions that will come out from you understanding the baseline from it.
Check it out. I put best channel to learn about first lien HELOCs.
There it is. There it is. I'm telling you, I wasn't lying. That's it.
GPT.
Yep.
That's good stuff. So the next question came from YOLO Vibes. Does this apply if just purchase primary? How to contact both of you?
So it does apply if you just purchased your primary. If you put You put 5% down on your primary. That means you have 5% equity. That means the loan to value on the house is a 95% loan. I can only fund 90%, which means if you want to get into a first lien HELOC and you owe 95% and I can only do 90%, you'd have to bring the additional 5% to the table to be able to get into the first lien HELOC. So it just depends on your scenario, but just that very question, does it apply if you just purchase it? Yes, absolutely. It's actually better to get into a first lien HELOC sooner during your amortized mortgage than later, because the majority of the interest that you pay on an amortized mortgage happens at the beginning. So you want to avoid the first 7 years of your amortized mortgage more than anything. So if you just purchased it and this can be a good fit from it for you, the amount of benefit that you can receive from it is a lot greater than if you're 5 or 10 years into it.
Good stuff, man. And another question from Sylvia Allows. So am I thinking correct that HELOCs are accessible, your own equity, or accessing, sorry, your own equity is why it's only interest payments?
So I don't know. Actually, I don't know. I don't know why they're interest only payments. So our first lien HELOC functions as an interest only payment for 10 years. Mm-hmm. And after that 10-year period, any remaining balance, whether it's $50, whether it's $50,000, whether it's $200,000, converts into a principal and interest payment. So the ability to pull from the HELOC continues for 10 years, but after that 10-year mark, it converts to a principal and interest payment. So that's a good question. I don't know why. I don't know if it's because you're accessing your own equity and that's why it's interest only. That may be, but there are other loans out there also that offer like short-term interest only payments, and then those convert into an amortized mortgage too, where you don't have access to it. So I just think it's just the nature of the loan at this point. But it's a good question. I don't know. I wish I.
That's a good answer.
Yeah, you got me. I'm not sure.
That's a good answer, man, because most people would try to make something up, number one, but also that's something I didn't know. So I just learned something new. So that's good. I like to learn. Let's see what else we got here. Are y'all saying first lien HELOC? It's first lien HELOC. So what that basically means is when you get a loan on a house, that's the bank is slapping a lien on your house. Right. So what this is a first lien HELOC. They're taking first position, putting a lien on the house in exchange for the HELOC.
Correct.
Is that the best way to describe that?
Yep. And the lien position is just basically who gets paid first if the person defaults. Right. So so when you have a regular mortgage, it's in the first lien position. And then the kind of HELOC that people know about is a second lien HELOC. So you get your mortgage, and then you open a second lien HELOC kind of on top of it. And so if the person defaults, first, the money that they get from it goes to the first lien mortgage. And then if there's money left over to go to the second lien position HELOC, then they get paid whatever's left over. First lien HELOC is one where it's in that first lien position, which means nothing else can be in the first lien position before it. So if you have a mortgage, it has to pay off your mortgage because it's in the first lien position. Basically, that's what that means.
That's right, man. Williams Alk. Williams Alk. I'm going to say Williams Salk. How's that? He says, what does it mean to burr the money out? So basically, all that means is you're buying a house, you're rehabbing it, you're going to rent it, you're going to refinance the money out, and then you're going to repeat the entire process. That's what burr means. So burr the money out means we're going to refinance the money out after we fix the property up and then go get another one in simple format, right? We had another one, and I agree with Sylvia Lau. She said, I don't like that this hurricane, Melissa. Is that the name of the hurricane? Is trying to mess up this great video. Yeah, Melissa don't like us today, but we still we pull through. You know, I appreciate that. Appreciate the support. How do you contact? So again, the links will be in the description box to contact both of us if you guys want to get in contact with us. Let's see what else we got here. This is a good question. Cheryl Young, is that a second on the primary home? Hence, first lien HELOC, but I'll let you take it from there.
No, it's not. It's not a second on the primary home. It's a first on the primary home and a first on both. I don't currently have a second lien HELOC available at this point.
Why is the first, this is a good question. Why is the first lien HELOC more beneficial than a second lien HELOC? Because they both have their strengths and their weak, I don't really see a major weakness with the first lien, but they both have their strengths. Why would
it's a good question. So there's some differences between the two. Like I said before, nothing is going to be the best fit for every person, but some differences between the two that I believe are advantages for the first lien HELOC are the amount of money that you have access to, and the fact that as you pay your balance down on the mortgage, you gain access to equity. So, we talked about earlier where you have, with a second lien HELOC, you have access to a mortgage, and then you get a second lien HELOC on top of it. So let's just say you owe $200,000 on your mortgage, and you open up a $50,000 HELOC on top of it. As you pay that mortgage down, you will never gain access to more equity than that initial amount that you're given. So in that scenario, as you pay that mortgage down, you will never gain access to more equity than that $50,000 that you first got with your second lien HELOC. It's just how they work. With a first lien HELOC, though, every single dollar that you pay down, you have access to. So let's say you have access to $250,000 and you owe $200,000 on your mortgage. This is the access point. This is the balance, right? As you pay down the balance, you get more access to it. So I know that diagram with my fingers is not super professional or the best, but that's the whole idea, is that as you pay down the balance on a first lien HELOC, every dollar that you put in, you still maintain access to it. With second, you don't. And so it doesn't increase. So that to me is one of the main benefits.
This is a good follow-up question too. Am I thinking of this correctly? Following a scenario, if there's very little surplus, then the product doesn't work out for you. Is that right?
That is what we find usually. Mm-hmm. Yes.
Yeah.
It's a good question. And it's one of those things where that conversation can be a sensitive one, right? And because sometimes those kind of things come with judgment. That's not the reality here. There's no judgment. To me, it's like I've lived there. I've been there. I've lived there for a long time, right? And I'm no better now than I was before, right? And I'm not, rolling or anything, but our habits are ones where we make more than we spend. But yeah, so this product itself relies on surplus. It has to have it for it to be beneficial.
Another question here from the same guy: is there a plan for your company to expand to Maryland? Why is it not available in Maryland?
I'm pushing for it. Maryland requires a brick and mortar building in their state for you to be able to do mortgages. And through the NMLS, which is the governing body of residential mortgages, we can get a federal charter or federal license because we work for a bank. Mm-hmm. However, that federal license, which applies to every other state, Maryland trumps that by basically saying you have to have a brick and mortar building in our state. So we're working on ways to try and figure out how to get that done. But that's why right now is that we just don't have a brick and mortar in their state.
What about Texas? What about Alaska? What about,
Texas has funny HELOC laws. Our first lien HELOC is connected to a checking account, and it automates the transfer of funds for you. So anytime you deposit money into the checking, it pushes that money into the HELOC for you. And anytime you spend any money with the checking account, it pulls from the HELOC. So whether that's going to the grocery store, for we got kids, like $250 now, right? Or getting a haircut, or getting gas. I spend $60 getting gas, and then it draws the balance on that checking account from zero into the negative by $60. That night, it sees the negative 60 in the checking and pulls money from the HELOC to reimburse the checking back to zero. Well, Texas has a law that the minimum draw that you can have is a $4,000 draw. So that means I would have to spend $4,000 to have it pull money to reimburse it. And right now our system is just built differently than that. I know that's a silly answer, but to build out a code, we'll call it, an automation that covers for Texas by itself isn't something that we've had the demand for yet to be able to warrant doing it. I want to get it done. I know there's an easier way to do it, but there's that, and they have other kind of really specific Texas HELOC laws that we need to kind of keep up with. That is just something that again is has been on the auxiliary in terms of getting it done. I'm pushing for it. I'd like to see it happen. I feel like I have a decent argument for why, but with other things that we've been rolling out, those are kind of taking priority at this point. Hawaii and Alaska, I feel like they kind of get the short end of the stick in general, just because, they're far away. And so I think that's why. So I don't have a good answer for Hawaii and Alaska, but I think just that because they're not connected to the other 48, they kind of, they don't have all the perks that everyone else does just because of that factor. So
sounds good, man. Appreciate that. And let's see. Is a HELOC available in your home residence, or can you also have a HELOC? That's what this is all about, pretty much. One True Soul. We're talking about both. So having it on a primary and then rolling it into your rentals as well. Yeah. So that's the program that Anthony's rolling out this week. Definitely reach out to him for the answer on that. Did you want to add anything to that?
No, that's perfect. Yeah. You can definitely do it on the house that you live in. That's your primary residence. That's usually what we want to do first, get your foundational first lien HELOC there, and then add on investment properties either at the same time in tandem or after you get your primary.
Perfect, man. Blackson 4, does your bank offer this product on rental properties yet? Same question yes, they do. So we're gonna stop that there. And then again, what about Texas? We just kind of delve into that. So look, is there anything that we're missing that we can add that will be a value add to the audience before we hop off the line, bro?
Man, I know that we've hit this a number of times. This can be new. This can be, it can seem foreign. It can seem too good to be true. When someone on YouTube says, hey, I may have a way that you could pay off your home really quickly without having to change your lifestyle. That sounds pretty crazy, and I get it. But if this is new, I implore you to check out those videos on Jamel's channel, because we go in depth in different scenarios. One's just a basic, here's what this is. We explain it. If this is a new concept, go watch those and take a look, because it's not a hard concept. It is new. And so kind of the tough thing that I find is people have to peel themselves away from what they know or what they think it has to be the way things work. And that's the challenge people have. But once they do that, it's like, oh, wait a minute, this is easy. It's like subtraction, and then it's like addition. This is not difficult. And so go watch those videos, take a look to understand what this is. I'll push that all day long. I'll push learning. I'll push education. I'll push learning about new things all day long. This is just another new thing, and it may have the ability to help improve your life. That's what we want to do. And so, and it may not right now, and it may later. So I think it's definitely worth your time to go take a look at those. If this is new, if you got a handle on this, you understand it, and you're like, I've been waiting for investment properties for first lien HELOCs for a long time, go ahead, book the call, and hop on with our team.
Good stuff, man. And what about modular homes? That was another question that came in.
Good question. I can't do modular. I can't do manufactured. I can't do the other M1. mobile. I can't do those three.
Yeah. Why can't you do modular or mobile homes?
So any lending institution is going to have different viewpoints of different types of properties. I can't do geothermal homes, right? I can't do really unique homes because there aren't places, because it's hard to find comps for those kind of homes. So manufactured mobile and modular homes are homes that within the bank's credit policy we're unable to lend on. So that fact in itself forces that rule upon us as well. So I think at our particular bank, for whatever reason, they probably see it or believe it to have a different or higher level of risk that they didn't want to enter into that level of risk for that particular type of home. That's the best guess that I have. All I know is sort of bound to the credit policy that the bank has, and so it sort of pushes onto this product too.
Plus, when it comes to modular homes as well as mobiles, those are tougher to finance from a regular bank. Those are more creative finance type of opportunities if you plan on cash flow, but it can be really hard to sell on the other end as well. So you got to be careful buying modular homes because whenever you get in a modular home or a mobile home, it's almost like getting a loan on a car versus a mortgage. Less people will qualify for those types of homes on the back end. So you're really limiting your buyer pool there as well. So that could be another reason. That's why I like to stay away from them. Although I've negotiated, seller financing on those types of homes before, but it was strictly for cash flow. I personally stay away from anything that's not stick built. That's just personal preference because of the limited buyer pool on the other end and a lack of funding for those types of properties. Really good question. Jamel, have you heard of home equity agreements, HEAs? If so, what are your thoughts? I have done extensive research on those. I'll say this because I do have experience with those at this point. Before, if you would ask me a couple years ago, I would say no, but I do have experience with it. You got to be really careful with those types of loans because they're taking a percentage of the equity in the property. So there's companies out there that will charge you some money every month, right? But there's other companies that won't. I'm not going to mention any names. You do your own research on that. But let's say a company was to provide you with a 10-year agreement, and the only way they're going to do the loan is because they know you have equity in your house. A lot of these companies, what they do is, let's say your home is worth $400,000 today, and in 10 years, it's going to be worth $500,000. They know that you're going to be paying down your mortgage over that 10-year time frame. Let's say you only owe $200 and it's worth $400, and they know in 10 years you're probably going to owe $125. And they also know that it's going to appreciate in value up to $500,000. What they're going to negotiate with you is a percentage of your final equity after 10 years. So let's just say, I've seen it as high as 40%. I've seen it as low as 15%. Let's just say, let's find a middle ground, say 30% of your equity. If your home is worth $500,000 in 10 years and they're taking 30% of that $500,000, let's just say that they give you $80,000. That means in 10 years, you're going to pay back $150,000. Okay. You may not have a monthly mortgage payment or anything like that. But if they give you 80 grand, you're probably going to pay double back after 10 years. It's beneficial to use something like that for short-term capital if you plan on paying it in under 5 years. If it's over 5 years, you might as well keep it for the life of the loan. You know what I mean? So it just depends on your situation. With a HELOC, second lien HELOC, or whatever, refinancing, you're going to have a monthly payment. 9 times out of 10 with an HEA, you're not going to have a monthly payment. But at the same time, if you add the math up and you find that the interest that you're paying over 10 years is going to be similar to, another investment vehicle, another financing vehicle, you got to look at your math, because everybody's circumstances, everybody's going to be offered something different on an HEA. Everybody's circumstances are going to be different. And if you're okay, if you feel like you can flip the money up and pay it off quickly, it may be a good financing vehicle for you. They don't care about your credit. They don't care about none of that stuff. All they care about is you having equity in your home. And I can do another video on this. I can really talk about this in detail at this point. But I just think that if you're disciplined with your money, if you're desperate, don't do it. If you're disciplined, it can be another way to get some fast cash within, a 2-3 week time frame. But you got to be really disciplined. You talk about high interest. If they break it down, it may equate to like, something similar to a regular HELOC, not a first lien, but a regular HELOC. So you just gotta do your research on it. Again, the amount of equity you have in your home will affect the amount that you can get, and the amount of equity in your home will the price range of your home will affect how much you're going to be paying back as well. So everybody's not the same. It's not a cookie cutter type of program, but you can get it done, even if you got a 500 credit score. So, but they can be preying on you as well. So just do your research on it before you move forward on something like that. I hope that helps you out. Question from Evolve 816 says, how long does a newly purchased rental property need to be seasoned before? Oh, that's a great question. Before you can apply for a HELOC on the investment property. That's a really, really good question.
So if the loan, well, basically, if you want to tap into the equity, right? Let's just say you bought the house cash, you don't have a loan on it right now. We're going to follow the same rules as cash out refinance. So it'll be a 6-month period. If you got a mortgage on the property and it was an 80% loan to value mortgage, you brought 20% down, I could do it right away because you wouldn't be accessing additional equity. So if you think of it in line with a rate and term refinance versus a cash out refinance, if you come up with a rate and term refinance, which is we're taking the loan balance, we're just replacing the loan balance, and that's it, you're not going to have access to any more additional equity, I can do it right away. If we use easy numbers, if you put 50% down on a $100,000 house, you'd start out with a $50,000 mortgage. If we came with a first lien HELOC at $50,000 max line amount, I could do it right away. But if you wanted to go up to an $80,000 first lien HELOC, we'd have to wait 6 months because that would give you access to an additional $30,000 on top of the mortgage amount that you had at that point. So we're going to treat it just like any other kind of rate and term, or any other cash out refinance, first lien, amortized mortgage. We follow the same rules.
Cool. Sounds good, man. Now, what's the difference in equity and fair market value? I think that's kind of the same question as how much equity you need in a house.
Well, so if I read this, if I think about fair market value, that's how much the house would appraise for, right? How much is it worth, right? And the equity is the difference between the amount that you owe and how much it's worth. So, for instance, if you have a home that's worth, the fair market value is $200,000, and you owe $120 on it, the equity in the house would be $80,000.
Right. So let me simplify that. If let's say your house is worth $200,000 and you only owe $120,000 on it, you have your fair market value is $200,000. Your equity is $80,000. That's the
Yep.
difference between fair market value and what you owe.
It's kind of like how much. Well, I was going to say, it's kind of like how much of the house do you own as compared to how much of the house is leveraged by the bank.
By the bank, right?
So
Exactly.
how much have you paid down, right? Or not even paid down. How much of the house, how much of that fair market value do you have direct ownership of because that's your money that's gone toward it as compared to the bank's money.
Right. Good stuff, man. Listen, like, subscribe, click that notification bell as well. Another quick question that came in. Well, this is a statement from Williams Alk. Anthony, please keep pushing from Maryland. He's interested. As of right now, you got to keep looking. You got to keep researching. YOLO vibes. What if my bills or monthly HELOC withdrawals would be less than $4K here in Texas?
So
again, this is a hypothetical because you're not working in, you're not,
because I can't do Texas for that exact reason, right? I don't know because I don't have first lien HELOCs there. I know what I would do. I would say that let's have the checking account only take a draw once you use $4,000 of it. That's the easy answer, but I think there's more to it than that from my bank's side of things. So that right now you're hitting on the same thing, the same reason why I can't do Texas is for that exact reason, is because most people's bills, most people's spend, the amount that they draw on a daily basis is less than $4,000. And so because of that, we don't have a system to be able to account for the $4,000 rule in Texas. So that's why we're not offering it right now. There.
Cool. Sylvia, you got about $313,000 in equity in your house right now. So your fair market value is $425,000 and you owe $112,000 to the bank. So your equity is $313,000. That is a ridiculous amount for anybody if you know what to do with it. You can turn that into a whole lot of capital if you wanted to. So you got access to $313,000 if it's your primary residence. In Anthony's case, 425 times 90%, 382, 500 minus 112. You'll have access to $270,500. Less a little bit. You got any closing costs with that?
Yeah. So this is a great example of someone who has a lower balance on their house. The value of the house has gone up while they've owned it, and they've paid the balance down too. I don't know when you bought the house, Sylvia, but if you bought it before 2019, you saw monster appreciation during that time, which helps your equity position just by having it, because the value of the house goes up, which means now there's more equity just because the value went up. And so, so this is a good example we were talking about earlier, where you have a lower balance in the house, you have access to a lot of equity, which now you can either leverage that equity to buy investment properties or get into opportunities elsewhere, or if you have an investment property already with a balance on that, you could take that balance and bring it into the first lien HELOC. It would increase the first lien HELOC's balance, but you could get rid of the mortgage payment on your investment property, which increases your cash flow, allowing for you to pay this off faster.
Exactly. Now, let me ask you a question. It's a personal question. You don't have to be exact with your numbers, but what does your income look like annually? Because if you're making, let's say, $100,000 a year, you can probably pay your house off in 1 year with a first lien HELOC. If you're putting all of your a year and a half, maybe 2 years, if you're putting all your income into the HELOC.
Yeah.
So what does that look like, Sylvia? Just waiting for your reply. And you don't have to use exact numbers, by the way. Said they bought the house 4 years ago and scored a huge deal. So they bought it with a ton of equity. Nice, man. That's how you buy. That's how you do it. But again, even if you don't want to share what that is, because this is the internet, If you let's say you only made $100,000 a year and you owe 112, you can probably pay off your mortgage in a year and a half because you have to live on some of that money as well. I'm not sure what your expenses are, but a year and a half, maybe 2 years, if you do it right, you can get this house paid completely off and have 100% equity in the house.
One thing to know also,
She said they're both retired. So I mean,
so Sylvia, one thing to know is on that link below, it's a 3-page process. The first page is just to submit your information. It'll ask you some questions. The second is actually a first lien HELOC calculator where you to see what would it look like. And then so basically that's the second part of this, is you get the chance to run your numbers with your income, with your expenses, to see how long would it take for it to pay off. And then after that, it'll give you the chance to book a call. So if you click on that down below, it actually gives you the chance to be able to run your numbers through the first lien HELOC calculator that we've got to make sure that it's a good fit for you as you move forward.
Let me show you guys what that actually looks like. I'm just going to pull it up real quick. So if you go to the link that's in the description box, this is what it actually looks like. You'll enter your first name, last name, email, phone number, and all that stuff. State what's your approximate credit score. It's going to ask you all of this information. And when you fill out the form, it's going to take you to a calculator. And then from there,
yes.
Or is this the booking? Is it going to take you to the calculator after this?
Yep. It'll bring you to the calculator next. And then you'll have the chance it'll ask you what's the balance on the house, what's the rate on your mortgage. It'll ask you your income. You want to use your take-home pay with that. It'll ask you your expenses. You want to input your expenses, your average expenses, not including your mortgage payment.
So I'm just going to do info@dealproacademy.com. I'm just going to do 800. Let's do California. Let's do a credit score of 720. And let's say as a primary residence, and let's just say that it's a refinance, right? So then you got that. This is all not real information, obviously. So now let's say that using Sylvia's situation, 425.
Hold on, but she doesn't know 425.
Oh, initial loan amount. I got you, 112.
Yep.
Current balance is 112, let's just say.
Oh, I'm sorry. I was wrong. This is my thing. I didn't even know it. That's fine. You're right.
Let's say it's $1,500 for insurance, for insurance, $1,500 for taxes. Let's just say the interest rate is 7%. Let's just say six. What's today's rate? 6.5. Let's say that the monthly income is $5,000. I don't know. Let's say that the mortgage payment is $1,500, and the remaining expenditures, let's say that you spend another $2,500 a month. I don't know. Calculate. So what is this telling us? 4.5, almost 5 years to pay it off.
Yep.
You put in, since you're spending $1,500 plus, you're spending $4,000 a month anyway between your mortgage payment and your other expenditures. What this is doing is lowering that to $2,500. So you're saving $1,500 a month, right?
And so then that next button,
the next button, you'll schedule a call.
Would then schedule a call. Yep.
Yeah. So this is explaining, like, so you'll save a ton of money. Now, let's say you were to put the entire $4,000 into it. This is a green light. This is a great fit. It tells you right here, right? Yep. Then you go ahead and schedule the call, and thank you for signing up. And then you'll pick a time and do your thing. So that's basically how that works. I just wanted to share that with you guys. But yeah,
that's great.
You know, I think that's good stuff. Let me stop the screen real quick. There we go. Yeah, Sylvia, this is like, I don't want to make any promises, but this sounds real good for you. Like to look in, like you really should take the time to look into this because you with 300 something, well, with 275, even 250,000. I mean, you're literally 4 flips away, make $1 million real fast. You know what I mean, or more. So but you have access to the capital. You can set your family up. That's what this is all about. Then when you couple that with the infinite banking stuff, be sure to check out my channel. I have a playlist on infinite banking. Anthony, DeAndre, we all talk. We get together. We talk about infinite banking, how you can tie that into this, and that's a whole nother powerful tool to be able to create long lasting. We call it generational wealth. That's an overused term today, but it really is wealth that you can pass down to your family. That's not bad at all. She said her interest rate right now is 4.5%. I put it higher, so you're going to pay this thing off a lot quicker than that.
Yeah.
And again, it had you at a $622 per month payment. It had you at let me repeat that, $622 per month on your payment. So imagine if you were really making $4,000 a month or spending $4,000 a month. Imagine if you dumped the whole $4,000 into it. How much quicker are you going to pay this thing off? Think about that. So I think you're really excited right now, based on the chat that we're looking at right here, man. But we're really happy for you. And, I would love to see you, how this goes for you. Be sure to keep us posted on it. Reach out to Anthony. Links in the description box. And man, this is in real time. You can't make this up. Somebody who can actually benefit from this. You know what I mean?
I love it. I love it. This is so great.
Cool, man. Any last words for our listeners, Anthony?
Guys, I'm just grateful for the opportunity to share. I'll push all day long for teaching this, for education. The reality is the numbers do the vetting. The numbers prove whether it's a good idea or not. So I appreciate the opportunity just to be able to be on here and chat. And hopefully you guys have found it valuable. That's really it.
Absolutely. Be sure to like this video, subscribe to the channel, click the notification bell. Listen, what else do you guys want to see on this channel? Leave a comment in the comment section. I'm trying to get into the habit of doing more lives, more YouTube lives, because we get to interact. It's good to shoot pre-recorded videos. That's perfectly fine. I'm obviously going to continue to do that. But when we do these lives, we get to really interact and really help in real time. So let me know what else you want to see. Anthony is an encyclopedia when it comes to HELOCs and lending and all that stuff. So let us know what else you want Anthony to cover on his channel. He's a frequent guest, just like DeAndre, just like Sawan, just like others that you see on my channel. I keep a tight-knit circle because these are real good people that I know care about you. So let us know what you want to see. We're going to continue to provide you with the value that you need in your life, in your business, for your family. We are family-oriented entrepreneurs. We are here to help you change the lives of your family. Be sure to check all the videos out. Check the playlists. Check out Anthony by visiting the link in the description box. If you want to get in contact with me, looking for real estate coaching, go to dealprocoaching.com. Whether you want coaching on your first or your next deal, whether you want to learn how to use the HELOC properly to build a rental portfolio, it doesn't matter. I've been investing in real estate for 25 years, well-versed in it. Like the video, subscribe to the channel, click the notification bell, and visit dealprocoaching.com as well. Check out Anthony, dealprocoaching.com, dealproacademy.com/HELOCs is Anthony, and we'll see you guys on the next one. Take care.
Thank you.